Hi, and welcome to Sunday Night Charts. We take a look at the charts to help you with the trading week ahead. And today's theme is going to be the color red. I'm your host, Steve Van Meter. Thanks for joining me tonight. And let's get right into what's going on. We got the trend indicators. Short term is 9 days, intermediate 21, long term 50, ultra long term is 100. Looking at the moving averages that you will see on my screen, the 50 days in green, 100 days in blue, 200 day is in tan. And we're going to look at price versus momentum. Price is the general direction prices are headed. Momentum is the rate of change. So think of it like you were in your car at a stoplight. Your momentum is zero. As you accelerate, your momentum increases. And when you get up to speed, your momentum slows down again. So same thing we're going to look at for stocks. A bullish indicator for both is positive, and a bearish indicator for both is negative. Momentum is often, but not always, leads price. Keep in mind, technical analysis attempts to determine where buyers and sellers are at. Resistance is level buyers can't break, and support is the level sellers can't break. Or think of it this way, resistance is where sellers are at, its support is where buyers are at. Also keep in mind the technical analysis does not predict prices. It can be used to determine the risk of a trade, help with timing a trade, and provide direction to the path of least resistance. Charting offers possibilities, not probabilities, and not certainties, and should not be considered a substitute for good old fundamental analysis. Let's look at the S&P 500, and you can just see the asterisks are the ones that have changed. We have a clear bearish picture now across the board on the S&P. Let's go and take a look at what's going on with it. And sure enough, we have a top and then a second at a lower high, and then this thing has rolled over as we've seen case counts around the world go back up. Lockdowns are coming back, and potentially uncertainty due to election on Tuesday, but who knows what's going on in the markets for sure. All we can see is the trend is, well, not good in the short term, suggesting that again the next level of support, as I mentioned in prior shows, is around the 3130. This is an area that bulls want to see defended and bears want to see broken. But even if you're bearish on the S&P, the next level is sitting right there below at just over 3,000, around 3,024. So look for a reclaim of the 200-day moving average. Again, for those who are bearish or bullish on the S&P 500, you want to see buyers back in the market there. Let's go on to the NASDAQ, and lo and behold, well, nothing but red here too, as the tech-heavy NASDAQ is rolling over and headed lower. Let's go take a look at the NASDAQ, and we see a very similar picture. As I mentioned before, the major level, or a level of support, I don't know if it's a major level, is at 10,000, say 500, and then you've got a more of a major level of support down below at 9,754. So I would say look for a retest of this 10,500 if this momentum trend change continues. Do keep in mind, let's dip back to the S&P 500 is not only below its 50-day, but it's below its 100-day moving average. Usually as price falls below moving averages, it is bearish until something pulls a stop to it. And then looking at the NASDAQ, you can see it's sitting right on its 100-day moving average. On to small caps, we've got the Russell 2000 with a little bit of green in the Russell, but everything else that was flipping back to the red category. Let's take a look at what's going on with the Russell, which just has an intermediate term price bullish flag, which isn't much to hang your hat on. Take a look at the Russell. You can see it was just skyrocketing here against the other indices as stimulus hopes drove small cap equities higher, and now with stimulus hopes likely dash until early next year around February, we see that the Russell 2000 is sitting under its 50-day moving average. We can see the moving averages are flattening and rolling over. The major level support for the small caps is around 1452. This is where, again, buyers have been, and bulls, it's okay. Hey, if you're bullish on the U.S. equity market, a retest of this support level is not a bad thing. It just confirms there are still buyers there, and those buyers want to buy. While we're here, let's take a look at the VIX. Normally not something we talk about in the Sunday Night Chart Show, but it is interesting because if the VIX I told you if it gets over this 31 zone that things start to get interesting, and we can see that in the equity market. Now it's over 36, and it's at a critical juncture. This is going to sound silly and say, well, it's either going to go higher or lower. Well, which is obvious. If it moves a whole lot higher, it's threatening to shoot up just like it did in March. So those who are bullish on equities really need to see volatility to come down. And on Monday, we'll take a look at the speculative positioning and see perhaps why so many people are betting on the short vol trade, because when volatility gets up into these levels, you can see it tends to reverse very quickly, except when it doesn't. And then all of a sudden, all those who are short volatility have to play chase. Let's move on to the energy sector, which is unchanged. It's still bearish across the board practically, except for a little intermediate term bullish momentum onto XLE. And you can see in the charts here, it is looking like it may retest its all-time low. And that could be, for those of you who like the technical side, a double bottom, potential bullish signal. But keep in mind that the energy sector generally doesn't recover until after the economy does. It's very rare that the energy sector leads a economic rebound. So it is possible we could see XLE actually go below its all-time lows. And even if not, let's zoom out and take a look at what a bottom in the energy sector often looks like. Here's a great example down here coming out of the great financial crisis, and you can see price led its 50-day moving average down and then oscillated around its 50-day for a very, very, very long time, and then finally started crawling up alongside its 50-day. So, if you're looking to, make a big move in the energy sector, remember long-term bottoms in the energy sector. Let's, I'm zooming in and out all over the place and I'm a little lost. Are long-term processes, and you can see the energy sector did not start to come out of this until the stock market, actually, several months after the stock market bottom. So keep in mind the energy sector, when it's sitting down in these levels, don't expect some shooting move higher like we've seen in the past. Look for a longer bottom in your charts. Okay, let's go on to the financials. And wow, bearish across the board now. Everything flipped. Many of you thought that the financials were pretty bullish, looking like they're breaking out. And I said, look, you knock on the door enough up here and you get told no, and you come down into support. Here is support on the XLF between, say, 23.23 and 23.83, where prices are sitting right kind of in that zone. If this breaks down, again, this is bullish for bond prices. When financial stocks go down, bond prices generally go up. So as I said, even though we've seen bond prices fall recently, bank stocks are telling us that potentially could be coming to an end, because if we see bank stocks break this level, well, now you're looking at them coming back down into where they were back in April, and then a potential retest of their March lows, if not something even worse. So what you're seeing here is a clearly looking topping pattern that if you're bullish on financials and you're bearish on bond prices, you need financial stocks to get going quick. If they don't find buying support here, again, look for a bigger move lower. On to the utility sector. Utilities are kind of a mixed bag. We've seen a couple flip to bearish. The short term is bearish. Intermediate term is a coin flip now. Long term bullish. Ultra long term bearish. No major signal on the utilities. So some of you might be wondering why I have put these charts together. Is because I use this as a means to identify opportunities, such as the energy sector. And that's kind of, if I'm looking long term to be in the energy sector, I'm not looking for a double bottom and a move higher. I'm looking for that long process of a bottom, something much longer than the equity market. How about industrials? Now, remember, they are more like the Dow, which we don't look at here. Complete switch to bearish. This was almost all bullish before. Remember, 1, 2, 3, 4, 5 have switched to red. And that is not positive for the industrial sector. Again, a lot of this was looking at stimulus. How about gold miners? Everyone's super bullish on these. Buy every dip, right? We hear that time and time again now that gold's going to go very, very high. And yet my belief, this is my fundamental analysis, says gold goes lower, then goes higher. And look at the data here. We see bearish across price, almost bearish across momentum, except on the long term. And let's go take a look at GDX. And so what it's done is it failed at this level up here between, say, 41 and just under 43. This was or is a level of resistance. Price came down, touched resistance and failed, could not find buyers, and is now going down looking for them. If we zoom out a little bit, the next level of buying for GDX is going to be pretty close to around, say, its 200-day moving average. This is where we've seen buyers here before. If buyers are not found, then GDX is looking back at its March lows pretty quick. That is not something most gold bulls are expecting at all. Let's move on to emerging markets, which is of all of these, the one I would expect to be leading equities lower. But yet on the short term, it just flipped bearish across the board. Intermediate term, it's bullish. Long term, it's a coin toss. And ultra long term, it's bearish. It's not actually giving any sort of prediction that I would want it to. And we can see that emerging markets have held up pretty well up here. And if this rolls down, it's looking at its first level of support. It's down just say around 42, 44. Major level of support around 41. Again, I'm surprised it has not moved lower alongside equity prices, but keep in mind, emerging market stocks can move very, very quickly when they do. But if you're looking at emerging markets, it's telling you everything's actually okay. Again, not something I would expect. Long-term Treasury bonds, as you know, fundamentally, I am bullish on. Everything else is pretty much telling you that, the charts are telling you I'm wrong on that view. But again, charts are possibilities, nothing more, and certainly not a reason to base everything you do on. And when we look at this, we have seen a massive selling position. We'll talk more about this on Monday. And despite all of the selling in bonds, you have a 4 standard deviation short position in the futures and options market, which is very, very rare. If you're not familiar, go look up standard deviations. You'll see 4 does not occur very often. You have foreign investors barely buying these things, and you have massive issuance. And yet, despite all of that, despite all of those things that are against the bond market, it did not get back below its March lows. It is not lower than it was in June, and it's not lower than it was in March. That's pretty darn impressive from a fundamental perspective. However, based on the charts, it is bearish. But from a technical standpoint, you've got this downward sloping wedge where you've seen selling after selling after selling. Should financial stocks roll over and head lower? Should the inflation numbers start to flatten out, which they are, and lose momentum, and you see a resurgence in this, there's a lot of sellers here that are going to get squeezed out. And that's probably the big key here, is we have seen right here at this current price level on TLT where buyers are at. They're in this lower purple zone. Looks like a street. You have 2 bands and a center line. We've seen buyers here. Buyers have been here, and so far, they're there. Now, we'll see how that holds up. But you've got to be pretty confident about it, given all the negativity against the bond market. How about high yield bonds? We've got almost a bearish picture across the board now on high yield. Remember, high yield are bonds that trade kind of like stocks. So if you're looking to be in the bond market and you don't want to trade equities, well, you can just be in high yield and you get some exposure there. And keep in mind, high yield bonds, they're looking, again, like the stock market, starting to peak and roll over. Major level of support on HYG is around 82.65 with a downward sloping 200-day moving average. If it breaks below, say, 82, maybe just slightly under 82, there's a little bit of support here at 78, 79. And then you're looking at a massive drop in high yield bonds, which would indicate defaults are coming. And there should be really no surprise, given there's no stimulus now for likely a couple months to help prop up the market. Take a look at gold. Again, everyone's super bullish on gold. The price across the board. We've got bearish signals, momentum. We've got coin tosses along that side. Fundamentally, if I'm right and real yields rise and the dollar rallies, gold's in big trouble. market is very deep-seated in its view on gold that there's going to be a major economic reset or currency reset. Highly unlikely in the short term, but look at what's going on from the chart perspective. The 50-day moving average is acting as a level of resistance, and now the 100-day moving average is acting as a level of resistance. So the next zone of where there's a little bit of buying support for gold is between 1800 and 1820. And there's, of course, more down from there. If that's not held, then there's a big zone here between, say, around 17 to 1750. And all else fails, then this thing is looking like it's going back down to around its March lows, perhaps potentially lower. If I'm right and real yields take off, it could be a wrecking ball for gold when you factor the dollar. You asked me to go over silver. Silver, we have bearish in the short term, bullish on the intermediate term, bearish in the long term, and a coin toss on the ultra long term. Let's take a look real quick at the silver chart, see if it looks any different. And other than it's hanging over its 100-day moving average, we see a same kind of setup where the 50-day is starting to act like resistance. If you're bullish on silver, you really need to see some buyers step in, and at this juncture is where you want them, because the next leg down for silver, you're looking at support is going to be down in the $18 to $19 range. I'm sure it'll tag its 200-day moving average like most things do, but there's not a lot of support sitting right there around 20, as you can see. Not much there, so not a big bullish picture on gold. How about the dollar? Of course, I'm bullish on dollars from a fundamental standpoint and from a dollar shortage standpoint. So looking at the short term, we have bullish signals. Intermediate term, bearish, that's okay. But look at the long term. It's not, starting to get flip and almost hold that bullish view. This is what, why did I put these things together? Why do I look at this data? Because I'm looking for things that either support my view or tell me my view is wrong. And a rising dollar is not something this market wants to see. It's something I want to see. And on the ultra long term, it's bearish. And this can stay bearish as long as the long term stays bullish, which will then flip to the immediate term and keep the short term moving higher. Let's look at that on a chart. And if you are a fan of Wyckoff, boy, this is about as pretty of a Wyckoff bottom as you can get. You see the price has been bouncing around its 50-day moving average, which is now starting to rise. You can still have a downward trending 100-day, but the momentum on it is slowing. Now, what I would be looking for to confirm my bullish view is a slice of the 100-day all the way up into the supply zone, sitting around 90 in the low 96s. That's what I'd want to see, and then I'd want to see it moving on up from there, or it could consolidate a little bit there before it moves up. Can it go back, dip below its 50-day one more time before it makes a move? It can, but this is about as clean of a bottom you want. It doesn't get much better than that. All right, last, let's take a look at Bitcoin, which appears to be almost off to the races. And I said last time that you would find resistance right where it pretty much at, right around 14,000 is pretty much right there now. So those who are bullish on Bitcoin would now want to see it get up to this, say, 16,500 ranges. I'm using some approximations here. If you get a reversal here, like it's happened several times in the past, then look for that to find support. So where is that support range? If it gets reversed, you want to see it find support between, say, 12.2 and 12.5. That's where you want to try to establish support. Otherwise, it's going to have to come back down a little bit lower. Otherwise, if the bulls are in control, then as I mentioned just moments ago, you're looking at a move up to, say, around 16.5. And I know a lot of people are hoping for that. As I mentioned, don't invest in Bitcoin, so I don't have any personal stake in the game. Anyways, thanks for watching. We'll see you on Monday, which I assure you will be awesome. We'll do a pre-election show, and I've got some cool stuff for you lined up. The content of this video is provides education information only and does not intend to provide investment or other advice. Material is not to be construed as recognition or solicitation by a security, financial instrument, or to participate in any particular trading strategy. This video is prepared by Steve Van Meter. Personal capacity to express this video that do not reflect the view of Atlas Financial Advising or Steve Van Meter Financial.